Hey everyone, welcome to your September 2022 housing market report. I'm going to walk you through three of the most important topics happening right now. Where mortgage rates are projected to go by experts. We're going to talk about home prices, and we're going to wrap up with affordability since that's on everyone's mind. So I do think we can rate mortgage rates this year as a volatile market. And if we look at here from Freddie Mac, this is their 30-year fixed rate as we look throughout the year. And you can see it has steadily increased from January until now. In mid-June, we saw the kind of top, and it's been volatility since then where we're seeing the up and down in the market. And you might be asking, what's influencing this? Well, the big thing is inflation. And we know the Fed doesn't affect mortgage-backed securities directly, but what they do is their actions are to help fight inflation, and how the market reacts to their ability to fight inflation is where we see mortgage-backed securities going. So when they feel like inflation is being battled well, interest rates go down. When they feel like inflation isn't being handled well, we'll see mortgage rates go up. So what are the projections going forward? So as you can see here, between Freddie Mac, Fannie Mae, the MBA, and the NAR, and we average all four, they are projecting that if the Fed can get inflation under control, we should see stabilization in the low fives going into next year over the next 4 quarters. Even some of these we might be seeing the high fours. And if we see this could bring a lot of predictability for our buyers and bring more people into the market as they see stability in the rates and not the volatility of going up and down like we've been seeing lately. So this is from Lisa Storvant, and she says it great, where after the end of the summer lull and as mortgage rates stabilize, we may see a return of buyers in a relatively strong fall housing market. So this would be great news. If mortgage rates do stabilize, we see more buyers coming back in the market. We know that the rising mortgage rates have caused many buyers to step out of the home buying process. But with these projections at hand, should they play out, we could see stabilization and a very strong fall housing market. We'll have to keep our eyes out on this, but this is something to look forward to. So now let's look at home price appreciation. And Keeping Current Matters actually surveyed about 400 agents, and they asked them what the top question with their buyer and sellers are right now. And of course, the number one thing is what's going to happen with home prices? Where are home prices heading? So, this is a very complicated topic where we talk about appreciation, deceleration, depreciation, but I'm going to do my best to break this down for you. So let's start off with Mark Zandi, and he says, I don't think national housing prices will decline in a meaningful way, but there will be some price declines across the country. So what does that mean? Well, on average nationally, we project home prices will continue to rise. We're seeing this in expert projections, but at the same time, we know there are some overheated markets in the country, and there might be in some of the areas that you work with where there might be some price declines. So let's look at this a little bit closer. So to bring this into context, this shows that home price appreciation going forward, based on today's buyer demand and low inventory levels, it still shows pretty strong appreciation. But we're also seeing where deceleration comes into play. Sorry about that. So let me walk you through this. This is a year-over-year home price increases for 2022 so far. This data is from CoreLogic, and it's, the latest data was just released. So you can see here the year-over-year data in January, February, and March. We were seeing pretty high rapid price acceleration, record-breaking beginning of the year. So what's happened since then when we've come out of the high 20% year-over-year home appreciation, we're just starting to see a cooling. And that's not necessarily a bad thing. It's making a more even market. And what you can see here is in May, June, and July, the deceleration happening. So what does this mean is that year over year, July, let's say July compared to July last year, we are still up 15.8% based on the national average compared to last year. Now that's slowing from the 20% we saw earlier in the year, but it's still pretty strong. And that's just deceleration. It's not depreciation where we would have negative price growth. But what we're seeing can confuse some buyers because you are seeing some people have to drop their list price. So you might see, a client where they could have sold for $400,000 over the last, 3 or 4 months. Now they're selling for $370,000. It feels like depreciation, but home prices are measured in a few different ways. So year over year, you're seeing the continued appreciation just at a slower pace. But month over month, we have to keep our eyes on this. That's why, you might have some buyers feeling that home prices are going down when they're seeing this on appreciation. But there's still low inventory and home prices are continuing to rise just at a slower pace. So we're going to keep our eye on this. But what this means that, a year ago, the listing price was more of the starting point negotiations. You might be able to list a little higher than what you thought it was worth. Buyers would still come. You'd have multiple offers. You'd have bidding wars. And then, the home and the price would go up. Where that was the floor negotiation, the market has now started to shift. So now we're seeing where the listing price is probably more of a ceiling of the negotiations. And buyers have a little bit more negotiating power, and we'll keep tracking these changes over month to month. So it's definitely something to keep your eye out on. So this is from CoreLogic, and it states, annual home growth slowed for the third consecutive month in July, but remained historically elevated at 15.8%. The graph I previously had up showed this. As a 30-year fixed rate mortgage neared 6% this summer, some prospective homebuyers pulled back, helping ease overheated and unsustainable price growth. We know the past 2 years has been an anomaly. The price growth over the last year in particular was unsustainable price growth. Looking ahead, CoreLogic expects to see a more balanced housing market with more year-on-year appreciation slowing to 3.8% by July of 2023. So by July of next year, CoreLogic is projecting that, home prices will still be appreciating in value just at a much slower pace, and that's just deceleration continuing. We are projected to see home prices continue to go up, a little bit higher this year and then start going down toward the end of next year and beyond. Leading up to the pandemic, keep in mind that the average home appreciation year over year was at 3.8%. So we're really just getting back to normal before the anomaly that was the pandemic. So you might be asking yourself, where are experts seeing this going forward? So you see in the middle column was the initial January 2022 appreciation for this year, and the far column is the updated appreciation for what they project this year. And they get this by looking at buyer demand, guessing on supply, inventory, and a lot of different things that drive home growth. And then they reforecast as the year goes on. So what's happening here is even though appreciation is decelerating, we are still low inventory. There are still buyers in this market. So that's why they are predicting appreciation to go up higher than what they thought. Because even though we saw a rise in interest rate, it hasn't softened buyer demand and increased inventory enough to, the appreciation that they thought back in January 2022. So this is still a good thought for people thinking about selling or buying now to capitalize on this appreciation throughout the rest of this year. And as I bring this graph to you, you can see the latest home price projections for the year, with the average of all 7 forecasts averaging out to be 11.3% annual percentage growth for 2022. Now remember, a lot of this happened earlier in the year, and we are seeing a softening, but by the end of the year, 11.3 home price appreciation for 2022. So why is that? It's because inventory is still low, is why they still think of the high appreciation numbers for the rest of the year. It just comes down to inventory. So as you can see here, we are up as compared, so this is for the week of September 2nd, and this is from Calculated Risk. You can see that we are up 26.3% in inventory as compared to last year. But when you take it back to 2020, we are down 5.4%. And if you take it back to pre-pandemic, we are still 42% down from where inventory was just back in 2019. So we still have an inventory issue of why home prices are still going to go up. And, this is where you can be the mortgage expert or the housing expert of showing actual data to people, not the doom and gloom that's in the media and stuff like that. Show them the actual data. Inventory is low, so home price appreciation is still projected to be high. Now, this takes us to affordability. A lot of people are saying or asking, are homes even affordable right now? So we're going to look at this from a few different angles so you can communicate this to anyone that you're working with right now. So this is the Housing Affordability Index tracked all the way back to the 1990, and this is released by the NAR, and currently we're at 98.5%. And you can see here the highest affordability in the most recent memory was right after the housing crisis, where distressed properties dominated the market, and it capped out at 197. So what does this basically mean? So when a reading is at 100, it's even. It means the average individual, the average household in this country can afford 100% of the average mortgage payment. So, what has even made it even more affordable recently, and what has added to affordability prior to this year, was just interest rates were so low, affordability greatly, benefited from this. And right now, the average household can afford 98.5% of the average mortgage payment. So yes, it's less affordable, but as you can see here, it's not an apocalyptic scenario by any means in terms of housing affordability. Now, this is based on three things. When they come up with the housing affordability index, it's looking at home prices, it's looking at interest rates, and it's based on wages that people have. So NAR also came out with this, where compared to 1 year ago, the monthly mortgage payment has risen from 1944 from $1,265, and that's an increase of 53.7%. So yes, home prices are less affordable right now, and mortgage payments have been increasing. If you look at this graphically, this is what it looks like all the way back into the last reading of June that's highlighted there in red. And this shows the most recent information we have in the statement that I just gave you by the NAR. No doubt, as people have gone through the pandemic, the meaning of home has changed. And they've said, you know what? We're willing to pay more for what we want. And we're seeing this right now in rising mortgage payments across the country. So if we look at this, we'll break down affordability and understanding this based on their mortgage payment in comparison to the income committed to the mortgage payment that they earn. And right now that sits at 25.4%, and this is assuming a 30-year fixed rate with 20% down on a median priced home and median income. As you can see right now, we're at 25.4%. And why is this important? Because the average is 25%. So yes, we're a little bit higher, but it's not in a apocalyptic scenario like we talked about before. When you hear the word affordability come out, you can give context to what this means to your home buyers. And one of the greatest benefits of owning is that you're at a fixed cost. So no matter what's happening on around you, you're at a fixed rate mortgage, your payment will always stay the same, and you can always refinance in the future. So we're not saying to buy a home based on the opportunity to refinance, but knowing if you can find a home that fits your budget, fits your affordability right now, we can always lower that later. And that's what you need to look at. And that's why they need to work with a mortgage advisor, so we can go through these different scenarios, maybe structure debt that they have in a few different ways to make it even more affordable for them. Now, if we further break this down, if you look at median household income versus qualifying income, it becomes very, very clear it's not the same across the country. So if you read this, obviously the West is less affordable. The South, it's basically neck and neck. And the Midwest median income is higher than qualifying income. So bring in your local information when you're seeing this happen, and your market is critical when you're talking to people, because they get a lot of their news from national news, but you need to base it on what's going on in your individual market. So in the U.S., though, it's sort of neck to neck when you look at it nationally, that the median income in this country is $91,952 versus a qualifying income needed at $93,312. So certainly seeing the rise in interest rate is lessening the buying power of consumers relative to the housing across the country. So we want to stay on top of that. But that's even more important to work with someone that is a broker like myself, because we can get lower rates versus our retail counterparts that can increase the buying power of your potential client, because we can get them a much lower interest rate at a lower cost. So you may be asking yourself, how can we help buyers with this affordability issue? Looking at their options to get them a lower rate, maybe broadening their search and going a little bit further out where there's a little bit less competition and it may be a little bit cheaper to find a home. You can also look at alternate financing solutions, such as a seller buy down, or asking for a seller credit to help pay closing costs, where you're not dropping the list price, so it's a win-win for the buyer and seller. At the end of the day, you just want to work with a mortgage professional that can really give all this insight to your buyers and help them really structure debt the right way to where the home is still an affordable option for them. And I'll wrap this up with Allie Wolf, and I think she said this very well when we're talking about affordability. We're in a place where strategy discussions and planning are critically important to making sure we can thrive during challenging times. You need to stay nimble, stay informed. Remember, housing is traditionally one of the first sectors that slow as the economy shifts, but it's also one of the first to rebound. And that's what you need to get out to your potential clients out there. So I want to thank you for listening to this and investing your time with me. You might be asking yourself, what's the best way to educate any clients that you're serving right now? Well, share our content on social media. We put out videos every day, but we also put together fall buyer and seller guides that has this information on there for your buyers in an easy to read format that you can use for your CRM, any clients you're currently working with, to have at open houses. So use this in different ways. We have also rolled out our No Buyer Left Behind program. So if you've had any past potential buyers over the past year that soured on the market because they thought it was going to crash, they're frustrating with being outbid on multiple offers, or maybe they were just trying to get better qualified, reach out to us to discuss ways we can show you how to capitalize this and get 3 to 5 more transactions over the next month. So if you're interested in talking about our No Buyer Left Behind program, reach out to us. If you're interested in game planning and strategizing ways to grow your business or how to use this information to make your clients feel more comfortable, schedule a mastermind planning call. Whatever you need, we're here to serve you. Thank you for taking the time to listen to the marketing report. Hopefully it wasn't too long for you and you got some nuggets out of this. Have a great day.